Hello, everybody. Welcome again to another special episode of Friday Drinks here on a hot Friday. It's been particularly hot this week.
Yeah, it has.
And so I'm actually going to have a Coke Zero, and but this is a sponsored show. And
yes.
One of
and
our
you guys have a bottle of wine between you.
Yeah, well, unfortunately, it has alcohol in it, so Ranga and I are not going to partake, but we're hoping that he will start making non-alcoholic wine.
Beverages.
Yeah.
Really?
We would. Yeah, I mean, then we would support him.
No way. No, I think I can support him for the three of us.
Yeah. So we know that there's a crowd that's out there that's actually watching the show and doing so while they're drinking their kumusha. So maybe you want to discuss a little about kumusha wine and why you particularly like. I mean, you've been following these guys for a very long time, and this is a local product. Tell us a little bit more.
Well, it's not a local product, but it's made by a Zimbabwean. The grapes.
That's good enough.
The grapes are grown in South Africa, and the wine is made in South Africa and bottled in South Africa. But it's a fantastic story of Zimbabwean entrepreneur. These guys basically emigrated, and they worked in restaurants in South Africa, and they learned the art of being a sommelier. And Tinashe and his colleagues, they set up the Zimbabwe team. So every year there's a competition. And by country for the best sommeliers, the best wine tasters, and Zimbabwe had never participated, or as far as I'm aware. And they, so somebody said, look, Zim's got some talented sommeliers who would do well in this competition that's dominated by Europeans, and they participated and they did very well. And he subsequently set up this brand, which he calls Kumusha, which is a Chardonnay name, which is fantastic. And he's the Kumusha brand has actually done very well. I follow him. It's this stuff is consumed
across the world,
all over the world. And
that's a very inspiring story.
Yeah, and he also produces another drug.
Another drug?
Alcohol is a drug, right?
Okay.
Okay, it's probably not the most charitable way of describing it. But yeah, he also produces, because he's from Nyanga, and he's also growing coffee. And he's going to, I think he's working on a Zimbabwean, this one will actually be grown in Zimbabwe and roasted in Zimbabwe, and so it'll be a genuinely Zimbabwean product. So my two favorite beverages, he's in that space. So I'm a huge fan.
Yeah. So maybe we can partake in the coffee.
He's sponsoring this episode, and I'm delighted to be having the Kumusha Kabsav. So cheers, Tinashe.
Cheers, Tinashe.
I wonder though why you're saying it's not quintessentially Zimbabwean. If it's being produced by a Zimbabwean, even if it's they are located in a different country, Zimbabwean. I mean the brains behind are Zimbabweans. Maybe they found
the intellectual property.
Exactly, the intellectual property is.
What does Apple say? Manufactured in China.
They say
designed in America,
California,
but manufactured
in China. Designed in California.
So similarly, Kumusha is designed in Zimbabwe, manufactured in South Africa.
and that must be a very good lesson for local entrepreneurs, that even with a fantastic idea, it doesn't matter where you then get to manufacture it. So if you think that a certain market offers you the best environment for you, then you can actually do that in that market. What's important is the intellectual capabilities that you can bring to the table, and then go to an environment where you think maybe there are better opportunities for you to be able to do your trade. So I would still call it quintessentially Zimbabwean, and the fact that it is even have the name Kumusha.
Yeah, and that's the intellectual property.
Yeah. I thought you were going to read the stories that you usually read from the bottle. This one saying Kumusha in the Zimbabwean Shona language means either your home or your roots or your origin. My journey is a constant pursuit of wines from vineyards that represent and honor their origins. You see, so look, it's we are not partakers of this one, but I look for those ones that really find it interesting. I think let's support this brand.
Yeah. Please share on X or on YouTube your glass of Kumusha, and if you do so, we promise that you're gonna get the producer, or he's gonna make the choice of who wins, and they will win a T-shirt and a cap, a Friday Drinks T-shirt and a cap.
Yeah. Thanks. It's imposed on me, but I think it's a fantastic idea. We can make it happen.
Let's promote Kumusha as much as we can. I think it's a lovely story, and this is the story of stories.
Oh yeah, and then somebody was so moved by the story.
John Mushayavanhu. I think it's got the town talking, and there are lots of highlights. There's so much that we can say about it. But I think that let's give the honor to Ranga, maybe to just run through the major highlights and just generally your thoughts around it and what you think is going to happen. It comes earlier than before. I think last year it was late. It came in April. But this time around, they stuck with the constitutional requirements. So just as a way of background, the monetary statement really is there to support the budgetary statement. So the idea is by December, the budget has been passed by Parliament, and then you need a complementary monetary statement to then underpin whatever the budget has said. So those are some of the things that we will look at, the congruency or incongruency of the budget statement and the monetary statement. Are they speaking to each other or they are not? And from my personal view is Treasury and Central Bank finally singing from the same hymn book? We know that for the last 4 years they haven't. So is that message coming through? Is this the same melody? And we'll get into the weeds. But maybe just from a highlight, I know that you've been looking at it for a while.
Just an interesting anecdote. They released, they called it the monetary policy statement at a glance. And what I found absolutely hilarious was it was 19 pages of at a glance.
Maybe because the main statement was about 76, 78.
Yeah, 76
yeah, 76, 78.
So you can glance at 19 pages.
And another area of highlight is related to inflation control, where inflation has generally been under control for most of the covered period, except for January, where we started to see a pickup in inflation, and all that is linked to the exchange rate stability. If you would recall, our inflation is mostly imported in a way because of the high imports that we bring into the country. So when you've got some exchange rate stability, it means even the inflation is also under control. And the theme remains a tight monetary policy. So the central bank or the monetary authorities are tightening all the levers of the monetary framework to ensure that maybe they maintain that price and exchange rate stability. And obviously it calls into question the aspect of at what fine point they have to sort of set up the monetary policy framework to ensure that there's a fine balance between price stability and also economic growth. Then another big thing that came out is around reserve accumulation. We all know that the ZiG, which is the local currency, is backed by some reserves, and the monetary policy is saying that the reserve figures have been increasing over time to a point where in ZiG terms it's about 14 billion versus deposits at 12 billion. So according to the monetary policy, there's actually more reserves backing the ZiG deposits that are on the market. I know we spoke about it last time, but the targeted finance facility is also another key feature of the monetary policy. So because of the tightening of our monetary framework, it's becoming very clear that credit creation and the private sector's ability to access credit has been constrained, as even banks are also reducing lending. So the central bank came up with this instrument to try and provide liquidity or loans or borrowing facilities to the productive sectors of the economy. And then there's been some attempt to try and improve the foreign currency, trying to bring some flexibility in the foreign exchange market, and also where necessary, some strategic interventions were being taken. I think that one speaks to the fact that I think almost $400 million was injected by the central bank in its intervention in the foreign market. But maybe the last highlight I just need to point out, maybe it takes us into the discussions around, the ZIG US dollar interplay is 83% of the total deposits are USD. So it means if you want to take that as a proxy of economic activity, maybe you'd say 83% of economic activity is in USD and only 17% is ZIG. And yet the monetary policy framework is actually targeted at the ZIG, economy or subsector, as it were. So I'm sure Mkhanya would have so much to say about that.
Yes. If I can just double click quickly on the 83% US dollar, because I think if you use it as a proxy directly, you're being conservative, because that's the ratio in the formal sector.
Okay.
And we know that the informal sector is more, it's close to 100% USD.
Okay.
So if you actually...
Your weighted average could be like, what
90%.
number? 90?
Yeah, so what we're saying, is that the market share of the local currency is probably less than 10%.
Yeah, so fair enough. So how are we going to do this? I thought, in our usual tradition, let's look at the good, the bad, and the ugly. Mm-hmm. And we'll start with you, the good. I think that was a nice summary. But tell us from the statement what you think is
so I'll just give
something good.
Before we get into the statement, I think it's important to give the governor credit for...
so this is the good.
This is a good, right? So because one of the complaints we heard a lot from the market when it came to their interaction with the Reserve Bank and monetary policy in general is that the Reserve Bank is insular. They don't consult players in the market. And this time around, I know for a fact that there was actually an engagement of capital market players. There was an opportunity for various individuals in capital markets to actually go to the Reserve Bank and spend time with the governor and share with him their 2 cents about what they thought the policy should look like. So I think we should give the central bank credit for that engagement, okay. And we think it's certainly a step in the right direction. I think going into the statement itself, the good news is that we haven't seen printing for the last few months, and given Zimbabwe's long, well-documented history of reckless and irresponsible printing, I think that's we.
I think what you mean is slower printing. Not that we haven't seen. They have been printing and then taking out the liquidity.
Well, okay. So certainly from a monetary, from a central bank perspective, because I unlike you, I just look at what the market is telling us in terms of the power market, the exchange rate there, and what you've actually seen over the last 2-3 months is actually pulled back, and the gap between the parallel market and the official market has shrunk significantly.
Yeah, so say that. Don't talk about the printing, but actually say that in the last 5 months, the gap between the power market rate and the official rate has actually dwindled, and it's it's evidence.
So there is some
convergence.
There's always been this. Gap between the policy statements, cooing about how things are very stable, and then the reality on the ground. And I think that gap has closed.
Okay.
So that's the good. That's coming out of.
Okay. All right. I will say my good, and I'll actually read out the paragraph because I think this is something that is worthwhile in just economic theory, which I think that the governor got right. So it's actually on page 10 of the MPS at a glance. And this is D, section D, which says the sustainable accumulation of gold and foreign currency reserves. And it's the third bullet, which says, and I'll read, the reserves accumulation strategy of the Reserve Bank in 2025 will therefore shift focus towards building up a buffer of usable foreign official reserves to adequately cover ZIG and to meet regional benchmarks of months of import cover. This is a good thing because from a theory perspective, they've been using reserves as far as reserves and amount of ZIG in the market. And we have continuously said that's not how it should be. It should be import cover. So we should look at an import cover and say how many cover of imports does 500 million cover? And I think that's the way to go about it. And that the governor has come out very strongly and has put out a statement that that's what he's going to do. I think it's a good thing. And I'm going to continuously remind the governor that he has said this, and that's what we need to focus on. It's just purely around the import cover. And he will find that the minute he does that, he will have a lot more leeway in terms of just what he does with the reserves. That it actually doesn't matter what the reserves are. The market now knows that if I want to import, the money is there. Because that's really why you need those reserves. And they should be accessible and they should be transparent. So that's a good that's coming out from me. Ranga, would you like to give us your good that came out of the statement?
So on the targeted finance facility, that has been extended to wholesalers and retailers. So they are also now allowed to access that facility. We know in the last 2-3 weeks there have been a lot of stories about some of the leading retail chains are struggling. And I would say the bigger part of the struggle has been because of the foreign currency exchange framework in particular, where government policy was one that was really forcing them to accept ZIG and also trying, even doing that at an exchange rate that was not viable. So obviously these players need to be supported. And beyond that, obviously there's need to ensure that the foreign currency framework is not one that is really placing a burden on players where they have to accept an exchange rate that is far from reality on the ground. And the current stability we are seeing in the market is good because if it means that over time, if we maintain stability, players will be indifferent in terms of whether they are receiving for the goods as ZIG or US dollars, because it's exchangeable at an exchange rate that is closer to reality. So for me, that was a big
a good thing.
Yeah.
Okay, great. Let's go to the bad.
Well, I actually think that what Ranga just spoke to, this targeted trade facility, that's actually one of the bad things about
Explain.
This monetary policy, because its very existence to me is a red flag, because what you're supposed to have in a well-oiled financial system is banks lending actively, right? They should have the liquidity and confidence to write loans to stimulate economic growth. So the reason why the banks are not in this position is because every time they are long cash, they get this unpleasant prize called non-negotiable certificate of deposit, right? Which is basically punishment for being liquid. So if on any given Sunday, your treasury is obsessed with getting rid or managing their liquidity, because if they're long, they get this unpleasant document, this unpleasant instrument, then of course they're not going to be able to lend. And, so it's just, so you now have this, extra layer of admin where the Reserve Bank has created a facility which the banks then need to deploy in the market instead of letting the market just sort itself out. So I think, and if you will actually ask the question, why do we have these non-negotiable certificates of deposit to manage liquidity in the first instance, it's because there's mistrust, right? What the central bank is telling us is that if the banks are allowed to deploy liquidity as they see fit, they will likely misbehave on the parallel market. So this is why we are tightly managing liquidity. But if we're not printing, then we don't have anything to worry about when it comes to how the banks deploy liquidity, because the exchange rate will not move if the stock of local currency isn't growing, right? So it seems to me, unnecessary to have this extra layer of admin and this extra operation where the banks and the Reserve Bank are playing cat and mouse and the prize is a non-negotiable certificate of deposit. It just makes life harder for the banks.
Okay. Ranga, do you want to respond to that? Because I think that's a good critique of your statement there.
So what Shumba is talking about is the ideal position. So ideally, the banks have to be the ones playing that role. But the reality on the ground is that the banks are not lending as much, and partly because of our central bank strategy of mopping up the liquidity, excess liquidity from the market, whether through statutory reserve, non-negotiable certificate of deposits, and other forms of open market operations. So now that has created a situation that there's so much, demand. There's demand for, credit facilities which the banks cannot meet. Also because the banks are worried. They are worried. They don't want to lend more because they are not sure how the monetary policy framework will change, and they don't want to be caught out with all these big loans. So the central bank is signaling that, they acknowledge that there has to be some credit that's being advanced to the private sector so that they can have capital to deploy. I think that can only be a signal. I think beyond that, the policy framework has to be such that the banks themselves are able to play that role. And in the monetary policy statement, there's talk about recreating or encouraging the usage of the interbank market. Because one thing that the governor was saying is, on a daily basis, the market is ending up in a positive liquidity position. But what's happening is there'll be banks that have got that liquidity position, which is positive, but others, they are in a negative scenario, but they're not trading amongst each other. So trying to then encourage that interbank trading will then just ensure that there's even spread of liquidity into the market. So that's the most ideal situation. Let's have banks do that. But reality on the ground, the productive sector has to be supported for now, and then maybe over time we let the banks take over.
I think I tend to side with what Shumba has said, primarily from this background. If you look at why lending is not happening, it's not necessarily because companies don't want to borrow. It's because the governor 4 months ago raised the statutory reserves for both US dollars and ZiG. Now, the problem I have is you can't raise the statutory reserves on one end, and then with the other, you open up another facility that's in ZiG. Surely, if the left hand was talking to the right hand, it would have been, I think we raised it too high. There's still latitude for lending to whatever the productive sector or whatever. Then you just reduce the stat reserves. Because the minute you reduce the stat reserves, the banks were going to lend. The banks stopped lending because you increase the stat reserves. But, and this is where I tend to, maybe you not go as hard as I would, but I will go, is it then, because there's a perverse incentive of why the central bank wants the facility. It's because they're actually earning 20%. Right? Because with stat reserves, they don't earn anything. And yet with the trade facility, they're offering the banks ZiG at 20%.
On the money that they're getting for free.
On the money that they're getting for free. So they're making a profit. And that's the perverse incentive. Because as a regulator, they should have just said, you know what, I think the banks are now too tight, but we want them to lend. then just reduce the stat reserves.
Yeah, you've raised a very important issue there, Mkanya. I've always had these questions. Maybe the bankers can assist us. So when central banks mops up the liquidity, whether in form of NNCD or statutory reserves or other, instruments, are these funds available to the banks? So assuming that you are in, the
short position.
You are short position. Are you able to call on the?
Well, ideally,
because it's still your
stat
money.
reserves. Stat reserves. That's why the central bank is the lender of last resort. Because when all else is, I gave you my stat reserves. Is that when I really need it, I should be able to have it, and you can charge an interest, an accommodation interest. That's how it should be. But I think that's why we now have this problem, because we're saying you're taking all this money at 0%, and then you're giving it to someone else at 20%, so they're going to make 20% profit on it, when really your primary role as a regulator should be, I took your stat reserves, so you're good, your capital is good and safe, but maybe it was too tight, and we can acknowledge that, and maybe we can restrict to who we accommodate, that it should purely be for manufacturers and retailers or productive sector lending, and we will give you back that liquidity and will reduce the stat reserve. So I think that it's competing functions within the central bank, because a treasurer saw an opportunity within the central bank and said, hey, we're taking all this money, and there are people who want this money, surely we could earn from it. But I think from a regulatory framework, they should really look at it from a policy framework and say that, you know what, if as the central bank believe that the market is too tight and we need the market to lend, then just reduce the stat reserve. Now, I would go one further and say, there's no reason why stat reserve for US dollars should be the same as ZIG.
Yeah, I totally agree with you.
So they should be able to reduce the stat reserve for US dollars and then say, but this should be focused on productive lending.
Yeah, so I think it raises an interesting philosophical question in my mind, which is, at a very high level, what is the role of central banks, and what is the best way to supervise and regulate banks? Because the Zimbabwean model is like the American model with the Fed, where the central bank supervises and regulates banks, but it also behaves, or it also takes on the responsibility of being the lender of last resort and banker to government, right? Whereas in a market like South Africa or in the UK, they've separated the role of a banker to government and lender of last resort from the role of supervisor and regulator of banks. So that conflict, right, where you're talking about a perverse incentive, right, because they're picking up this money at 0 and they're lending it out at 20, right? That's an incentive to behave in a particular way, which might conflict with their role as the supervisor of banks, because an independent supervisor of banks might frown upon that, right, and say, well, actually, this is not equitable way for the central bank to.
You use the word equitable.
Because the supervisor of banks would also supervise and regulate the central bank, right? And how they interact with the other banks. And so
you're right.
So I don't know whether it's the best model. I mean, the proponents of what we have say, look, by trading with the banks, you have better quality information, so you're a better supervisor and regulator. And you can always manage the conflict. And then the other argument,
but your partiality then is called into question.
Yes,
because you are both a player and a referee in the same match.
Absolutely, absolutely.
So I also want to just highlight a few. We are still on the bed, right?
Yeah. Okay. Go on the bed. Okay.
Yeah.
Highlight.
So for me, the big one is the exporter retention threshold.
Okay.
Yeah. I think
it went up.
Yeah, it went up.
5%.
So from 25 to
30%.
And on this show, we have actually been clamoring for that number to actually be reduced. And if not, that foreign currency that is generated from that, I think its deployment will then need to be really, I think even market related to a certain extent, And we have got a situation where an extra 5% is being taken from the exporters. Look, I understand it's from the point of view of maybe trying to boost the foreign currency coffers of the central bank and etc. But I didn't like the second aspect to it, where now they're going to be issued with another paper. We are just coming from a scenario where private players are being issued with paper every time central bank or sometimes even treasury finds its way of taking money from private players. They give you some paper. What I've seen in the papers, including the treasury bills, is when it comes on the maturity date, the government is not paying. So we have got this scenario where you are told that, the extra 5% you are taking from you, if you don't have any plausible reason for deployment of a ZIG, we can give you a paper. That's actually not progressive, because in a way the central bank also wants to police the ZIG.
I think you raise
that you're getting.
Ranga, you raise a very important point here, and I think it comes back to a debate that we usually have, which is expansion of money supply and management of liquidity. So money supply can actually increase, but you can still have a tight liquidity because you're managing the liquidity. So them issuing out this paper doesn't curtail money supply, but it's a way in which they're controlling the liquidity in the market, because they think that it's more important to control the liquidity. But at some point, the chickens will come home to roost. At some point, you can kick the can down the road, but at some point, you've already created the money. And that's an argument that I've often had. And I think
I'm agnostic about the retentions, whether they're 25%, 30%, 50%, or 100%. If your currency is changeable, is fungible, it shouldn't matter what whether your retention is 0 or 100%, right? Because when you need hard currency, you can get it, right? What I find really egregious is this idea that you're issuing a piece of paper that says, I owe you and I'll pay you when I'm good and ready at some future date, right? That's because if you're an exporter, you're a business, right? That just happens to sell to people outside the country, right? And when you invest in your business, right, you're thinking about your cash flows without knowing that one day some of your revenue is just going to be confiscated from you, and you're going to get a piece of paper saying you'll see this money uko. That just, it's really, really bad for investment and planning. So I really feel for the exporters in this regard, because it's just a
why
nightmare.
are you agnostic?
The retention shouldn't. You see, if the currency is fungible, right? So let's assume,
but we know it's not.
Yeah. Well, so far it's behaving like it's fungible, which is exactly why they're issuing this instrument, right? Because with the other 25%, right? If an exporter doesn't have enough hard currency for an import, they can go to a bank and apply to import with their 25% retention, right? But this 5%, you're holding a piece of paper that you can't actually, that's not liquid, right? You're being told liquidity is going to happen, and it.
No, they actually say whenever you need the ZIG. So this one is a US dollar denominated, but it's convertible into ZIG.
And they will actually offer you a 4% interest rate. But in ZIG, which means it's actually money printing.
Yeah.
But they're managing your liquidity. Because they know that the minute you've increased it from 25% to 30%, it means that the amount of ZIG that
has to be injected
has increased. So they're now managing the liquidity. That's why I said, from a money supply perspective, the money supply has increased. But what they're trying to do is to manage the liquidity. And so that's your bad.
That's my bad.
So I'll give you my bad. My bad is very simple and straightforward. As far as how does the monetary policy statement speak to the budget that came out in 2024, which is actually for 2025? And what I see as a big question, the elephant that they didn't address, has to do with the treasury bills that were issued by Treasury and were due in the last quarter of 2024. That's about 177 US dollar million US dollar TBs that were due and then were rolled over. And then that created a bit of a liquidity crunch for a lot of the banks because the banks were expecting that liquidity to manage their affairs. The central bank totally ignored that. Now, I get worried because they are superintending, the entire financial services system, and we've got 785 million worth of TBs due in 2025, and we need to plan. And when I look at that elephant and the way they've ignored the elephant, what comes to my mind is that, and going back to why exporter retention has actually been increased from 25 to 30%. I think that the governor is laying the groundwork for monocurrency. But unlike John I or Gono, he is not one to shock and awe, but he is one to introduce it slowly. Because I think that the rest of the year, you're going to see that retention increase even further. I think John Manguja started at 60-40. Gono again had 60-40. You're gonna start seeing that increasing, and they want to see how the market reacts to it. And then that's why they're now issuing out more and more of our ZIG. You've seen lending will be driven primarily by ZIG. Retentions will be in ZIG. A lot of this paper that they're issuing will be in ZIG. Treasury is going to be issuing a lot of ZIG or converting US dollar TBs into ZIG. So I think that this is the way, if I were to read in between the lines, this is the way in which the governor is doing it, is slowly and gently introducing monocurrency.
But the reality on the ground actually seems to point to
the opposite.
The opposite.
Those are his intentions.
Yeah. So there's the intentions, then there's the reality.
Speak to it.
Because the tightening, what the tightening monetary policy has done is it has actually taken us from an environment where at some point, ZIG and US dollars were operating side to side in terms of the transaction. But right now, most of the transaction, I would say maybe, in fact, we have just agreed that the average, when you take the US dollar, the formal market and the informal market, we are probably at 90-10, and we were probably around 80-20 some few months ago. So what has happened is in the market, in the economy, the usage of ZIG has actually slowed down. So you're talking of his intention, which is to foster more usage of ZIG going forward, and we're seeing those signals in terms of where lending has to go and also the retention. But the reality on the ground right now, the average person, when they're transacting, I think 90-95% of the times it's in US dollars. So I think when it comes to the currency issue, I think for me it's a confidence issue, and that that is not just a function of how tight your monetary policy is. So that's why I really have a bit of questions when it comes to the talk of the stability, because you want to say something is stable when it's freely available. ZIG, there's no ZIG. So I don't know where it's stable. It's stable out there, but in the actual economy, it's not there. I think it has to be, transacting alongside the US dollars, and then you have this rate holding for this long. Well, at least it's there in the economy, but right now
and
it's just
interbank market.
Yeah, and interbank, it's just not there. And my worry is the day
in
that
capital markets or in equity market, what do you call that when there's just an offer or a bid, but there are no trades, and then you say it's stable?
Offer?
I can't think of anything.
The price has been stable, but they haven't been active trades.
But the axiom that is true is that the price is a better reflection of fair value when high volumes trade.
Yeah,
right. So
exactly.
So whatever price you get when the volumes are low is less likely to be a fair price than when you see significant volumes changing hands.
And it's interesting that you say that, because the same day yesterday, guess who else on the continent released their MPS? Kenya. and they had 5 months import cover, lots of trades happening. The Kenya shillings, speaking to your point, around import cover and lots of trades happening and saying we are adequately covered as far as that's concerned. So, I tend to agree with you there.
So this is, a valid criticism of the current framework because you have the fungibility is limited because you have all these rules around transacting, right? So in the first instance, you've got this idea that the banks can only give you US dollars against ZiG for priority items, right? Yeah. And the argument I've always made is why do we have a priority list, right? At all, why if you've worked hard and you've paid your taxes, why should the state or anyone care how many US dollars you buy with your local currency and what you use them for, So, and if you actually look at the history of economic growth, it tends to, you get more of it the more fungible and the more tradable the currency is, with China being the one big exception. I think we're much more like the West than China. And
well, the rules of economics, China does not, it actually subscribes to the rules of economics. So the rules of economics are, if you're going to have a fixed exchange rate, then your reserves have to be really high. And if you have a market-determined exchange rate, you actually don't need reserves. So when you look at the U.S. reserves, they're less than 2 months.
No, they don't. Yeah, they don't really have reserves.
They don't really have reserves. And when you look at China or Russia, they have 2 years worth of reserves in terms of import cover, primarily because they're saying, okay, we've got a fixed exchange rate, but we're willing to defend that rate. And how the market knows and acknowledges that, they can defend it, is they're saying, even if we don't trade at all, if the economy were to close down for the next 2 years, we'll be able to import without any hassle. So those are the trade-offs. So and it comes across as far as your policy is concerned. That's why I say the good that's coming out of this monetary policy statement is actually the governor has come out clearly and he has said we will start looking at our reserves from an import cover perspective, and we will look at what the region is. Governor, Kenya has 5 months worth of import cover, and that's what we should aim for. If we have that, then there is a certain level of confidence. Then you don't need all this paper that you're introducing into the market. You don't need to know what Rufaro is going to import or what he wants to import. That's up to him. All you know is if there's an invoice, even if we're not producing anything at all, we can cover up to 5 months of imports. So that's the language that we want to hear more and more of.
My second bet.
How many bets do you have?
We only give one. But we go into the
where did you learn to count?
Do you know why I have to raise this one?
Okay, let's raise it as an ugly.
No, I don't want to call it an ugly.
Okay, it's a bad. Okay.
It's still a bad. Maybe you could classify it as an ugly.
All right.
So look, I'm a financial analyst, and obviously, I'm always interacting with data, and I need to get data in a certain quality, shape, or form. And I think this idea, our directive of making ZiG the reporting currency, it's a bad for me. I don't know if you could...
Speak. That's ugly, actually.
It's ugly, but
please speak to that and what it means.
Yeah.
Because they seem to be imposing ZiG reporting as the standard right across the
So I understand. I think what the governor is trying to do is trying to signal, like you're saying, to the market, to the economy, that the economy is going ZiG. So the monocurrency aspect that they are talking about.
So we're currently at 10% and we're signaling that we're going to ZiG.
Yes.
That's what we're doing.
It's just a SIG. I totally agree with you. It's too early a signal, but they're saying, you know what, as you're planning, your frame of mind must acknowledge that we are going monocurrency and ZiG is going to be the way forward. So I think in future you need to start having to have that alignment, even in terms of your strategy and the way you look at the financial markets as it were. But the problem is when I'm looking at it, and if you are agreeing on the 90-10, so we are actually saying we have to convert the 90% to reflect or to be in alignment with the 10%. Do you know what it means? As I'm not an accountant, I'm an analyst, so I'm a user of reported financial statements. The moment you introduce that element, you are distorting the finstats in a big way. It's one thing to say convert the 90, do the 10 to look like the 90. But to say convert the 90
to look like the 10.
To look like the 10. And then it's to expect the number that comes up from there to mean something. I mean, it's crazy.
Yeah, I think that's why I said it's ugly, because and from my perspective is, if you look at how the ZiG has performed, because right now the inflation rate that we're getting as far as ZiG is concerned is month on month. But when you look at April, where ZiG, remember ZiG was introduced at 13 and now it's around 26. So when you look at yearly annual inflation, it means we're already in hyperinflation because it's above 50%. The price change between last year April and this year. So you've got 10% in a hyperinflationary currency, and you're then meant to convert the 90% into that. I think that speaks to the gibberish that you continuously tell us.
Look, local currency numbers are gibberish.
Yeah. And on the ground,
and I think that the governor should have really been more gracious there.
So on the ground, you are keeping your transactions in the actual currency of trade. So it's your 90% you're trading US dollars. That's the transaction of record. Because you are saying, I've sold for 500 US, and you've sold for 500 US. So you're having to record all these numbers in the currency of trade. And then at some point, reporting period, you have to convert them.
I'm amazed that he thinks it's bad and not an ugly as a capital markets.
That's an ugly, because it distorts capital markets.
It does. And also, it's actually bad for Zimbra.
Yeah.
It's bad for Zimbra.
Yeah.
Because so if you're gonna tax me on my profits, right, as a corporate, unless Zimbra is smart enough to say 90% of your trades are in USD. Show me the current books.
Law. The current law is you're taxed according to the currency in which you traded.
Yeah. So what are we saying?
No.
If you're acknowledging that,
to me, it's just.
Is it too difficult to say? Look, I understand the signaling. That's okay, but let's acknowledge the reality on the ground that 90% of transactions are in USDs.
Yeah.
Right. We acknowledge that, but then you say as a requirement, right? Maybe present
supplementary numbers.
Supplementary numbers can be in ZiG, but let's acknowledge the reality that 90% are in.
US dollars.
Because the fiscal.
No, I absolutely abhor this idea, because.
So would that be your ugly as well?
So we've upgraded to the ugly.
Yeah, because think about it, pick any counter on the Zimbabwe Stock Exchange, right? If you look at a set of 2024 numbers, right, you've got, and typically they're presented with the 2024 numbers next to the 2023 numbers, right? And the whole point of it is, at a glance, you can see whether there's been growth, right? Top line is revenue going up in real terms. Bottom line, what's happening, right? You can start doing some really basic analysis just by looking at the numbers. Now, I can tell you that if you look at any set of 2024 accounts in local currency, the 2023 numbers, you are meaningless, right? You can't make heads or tails of them, because you don't know whether most of that income on the revenue line was earned in the first half of the year or the second half of the year. And the exchange rates for 2023 in the first half of the year is completely different from the exchange rates. So that number that you're seeing there, and then the accountants do this gymnastics called inflation adjusting, right? So those numbers were...
You're going to have to. With ZIG, you're going to have to, because the inflation rate is above 50%.
When they were prepared in 2023, they did the inflation adjustment, right?
ZWL.
And then they were inflation adjusted. And then to move them to 20, so that they can put them next to the 2024 numbers, they do a whole bunch of adjustments as well, right? So by the time you actually, look at the 2023 column, I mean, your head is just, you're having a migraine.
It's meaningless.
Right.
And you think that the directive is coming on the 2nd of February. Already these guys have been doing something in the background, preparing for their numbers. What are they going to do? Start again? It's just so annoying, because the biggest beneficiaries of this are the accountants, because they're the only people who actually understand how to inflation adjust accounts, right? And they charge extra for this, right? But these are numbers that nobody uses because they're useless,
Okay, so my ugly is a simple and straightforward, and it has to do with Nostro in our banking sector. So the latest numbers that we have is as of November, and that's about 690 million that's now in the banks, held as actual coins and notes, and offshore balances, real US dollars, compared to total deposits, which is now 2.5. So just as far as historically, the highest we've ever been was under Mangujga, where we had about 1.2 billion worth of actual cash, and which was the highest actually we've ever had as a country, which means speaks to a lot more money was in the system. But beyond that, I think there's now more and more money that's outside of the banking sector. And I think that that's an ugly thing, because we are worried about that. And I think that the governor needs to be supported, as far as we're concerned, to make sure that we don't have TBs that are coming again into that. It's now a very fragile banking sector.
Is that why there was a subtle threat about people keeping money in their self-deposit? I also
think he has no control over that.
That's
I think that's a statement he just had to say, because he has no control over that. But
it's ugly in the sense that the money which is in the self-deposit box, the way I interpret it is someone who says, I don't trust the banking system, but I'm happy to keep it here because I will use it mostly here, right? So the moment you start to create some, discomfort around that structure, you know what will happen?
People will ship the money out.
People will ship the money out.
No, that has already happened.
And you know how difficult it is to bring money back, even your money. I mean, like, you want to pay for something immediately. You're at the service station, you want to buy fuel. If it's in a safe deposit box, I think you can make plans to go and, retrieve it from there. But if it's offshore, so some of these statements, I think they only work to, heighten the level for discomfort in the market. So there's a lot. I don't know.
So my ugly is a simple and straightforward one. Is that the Nostro market at the moment holds. It's less than 20%, but still above 10% of actual cash, which is fine, because I think generally around the world, it's around 15 to 20% of actual cash supports whatever total deposits you have in the market. But the Nostro market, cannot afford more or new TBs. And that's my big worry, is that right now we're in a precarious situation.
What about this rallying call to banks to lend more of the US dollar deposit? Won't that add to that worry that you have?
Well, actually, it's not to lend more. It's actually to reduce. Okay. So what the governor has actually said in his statement is there's a lot of concentration risk where people have lent out US dollars to particular clients, and they need to, over time, scale back on that. And I think that's a good thing. That's actually one of the good things. It wasn't a big good, but it is a good thing. I agree with him as far as that's concerned, because he wants to bring a bit of diversity in the Nostro market. I think that we should, in 2025, we should do our darnest to ensure that the Nostro market still holds. I know it's going to be a tall order, but we cannot afford even 10 million worth of US dollar leaving our market. It will have a an inordinate impact on the market. If you remember, if you look back on RTGS dollar and the history of RTGS dollar, is that by 2016, we still had, about 15% worth of deposit. But why in 2017 there was no US dollars at all in the market? It had dwindled to about 200 million that was still in the system.
So, okay.
And then by then, there was no RTGS.
I want to probe your thesis here because I believe in the notion of once bitten, twice shy. So, what happened in 2016, 2017 is that the bankers could see the writing on the wall. They could see, they had front row seats to what you're warning us about right now, right? They could see the ratio of bank balances to actual cash and Nostro offshore shrink to the point where the bank balances stopped being US dollar bank balances and they became local currency bank balances. So do you think that they would quietly sit through another such step change or transition without warning their customers?
That's actually a fantastic point, Ruvaro. And let's look back at history. Is there any bank on the legacy debt?
No.
There's your answer. So the guy who suffers is never the bank. Because the bank, to use your popular statement, is agnostic. Whether it's US dollars or it's ZIG, whatever.
It's not their money and they don't care.
It's not their money and they don't care. The guy who ends up with the wrong end of the stick and then is pushed into a legacy debt is the customer. That's straightforward. Banks, in fact, they're extremely agnostic. They want to make money. That's all. There's no bank that ended 2019 and was on the legacy debt. None whatsoever.
And on their part, most of them are busy crystallizing their capital.
They're crystallizing their capital.
That's why they're building these corporate head offices. Maybe they were not planned like 10 years ago. So I'm not sure where this thing
will go.
So with my own
you can
capital,
actually use it as capital.
Yes.
So those buildings, that head office, you can use it as capital.
You see, and I think that's why they are skeptical when it comes to the interbank. So you are pretty much protecting your balance sheet and say, I'm not too sure how exposed the next guy is. But as far as I'm concerned, with all my balance sheet, to the extent that I'm able, I'm going to crystallize it. So I totally agree with you that the banks here, they really have got no skin in the game. Whichever way they're winning, heads or tails. Yeah, these guys are winning.
In fact, some are praying for a restart.
In fact, that's what I was going to say. That with that in mind, I think I can just imagine you're sitting in an asset and liability commit meeting of a bank and say, guys, okay, this is our balance sheet. What do you do? I think these guys will just be telling you that no. Go out there. Let's crystallize. The amount of liquid assets on your balance sheet, you have to reduce it as much as possible, and just make sure that you've got solid.
In fact, what you're saying actually speaks to why the banks are not lending.
Exactly.
Because they don't believe in what's going to happen in the future. Because if you're lending US dollars and you don't believe that US dollars is going to be the currency of choice in the next 6 months, then you're going to hold a liability at the end. So right now you just say, you know what, let's scale back our...
Let's make money from transactions, fees and commissions, net interest income. No.
Not so much. So I think that we need to... Where we can support the governor is the governor has to really support the Nostro system, because if the Nostro system is not supported, then another restart, it's not what you want. And, that legacy debt, remember, it's set with the central bank for about 4 or 5 years before it was taken over by Treasury. And it's now part of the public debt. And then this time around, we cannot afford that. And if that sits on the central bank, it has lots and lots of implications of our monetary system. So I think that let's try whatever we can to protect the Nostro. I think it's much better to switch from a Nostro to ZiG, local currency or mono currency, and you do it seamlessly, where there's a immediate switch and no one owes anyone, and there's no legacy debt. But I think that the problem that we have is, this is as of November. We don't know what it's looking like as of February. So this is 4 months on. The latest numbers that we have is as of end of November. And it was now 690. Just to give you, in September, it was around 800 million, and it's come down. At beginning of the year, it was around $1 billion.
Yeah,
and it's come down to about 690.
So I would say, look, the governor has tried, and earlier on you asked whether there is congruence or the fiscal and the monetary side are speaking to each other. Well, I would say to the extent that maybe there's a gap, the Treasury must, ordinarily monetary policy support fiscal. I hope. I don't know if that is the scenario that we have, but the signal that you are seeing from the central bank is they're really trying to tighten the ship. They've actually identified the problem areas, and they are really looking, their eyeballs are exactly everything that they should be looking for, which is price stability and also exchange rate stability. But the fiscal side also has to play its side.
There's one number that maybe we need to speak to Mtuli. Is Mtuli's budget, he's got the exchange rate at 36, right? He says we are collecting about 7.5 billion, and then he says the exchange rate will be at around 36. Monetary policy is saying that the exchange rate might actually strengthen or remain around 26.
In fact, what the governor says is it should be 22.
23.
Yeah, based on the relationship between the reserves and the deposits.
So that's our advice: is that Treasury fiscal policy needs to speak to monetary policy, and monetary policy needs to speak to fiscal policy, and maybe we need that reality check that the rate is going to get to 36. So monetary policy needs to support stability at 36. Or it's the other way around.
If the rate goes to 36, then stability is out the window. How is it stable?
Touche. Okay. I take my point back. Ladies and gentlemen, thank you very much for joining us for 2 glasses of Kumusha. How many glasses did you guys drink? Please let us know and share those pictures on X and everywhere on our social medias, and we will certainly give you a reward. And it's all dependent on who the producer chooses to win a cap and Friday drinks.
Overly,
can the producer tell a post of a glass of wine apart from a post of a glass of juice?
All right. So we need Rufaro to adjudicate.
Okay. Maybe before you end the show. So in my early days as an analyst, one of my bosses earlier on, whenever I would go to a Kanban presentation, he'd say, "Ranga, you went to this briefing in just one word. Good, bad, or ugly." Like, he wants you to characterize the results of a Kanban in just those: good, bad, or ugly. Starting from Shumba, good, bad, or ugly, the MPS?
Jeez. Well, it's definitely not good. I'm sorry to say, but it's not. I'll stop at bad.
Good and bad.
I'll stop at bad.
Okay.
No, I'm the one who is supposed to.
All right. I don't think it's ugly. We've seen ugly. And I think that ugly was 2019, 2006 to 2007 during Gono's years. And then 2019 was ugly.
Okay.
This is bad. It's not good. It's not ugly, but it's bad.
Can I?
Yeah.
You have to be a contrarian.
No. I certainly agree with you. It's difficult to call it good, but I think maybe bad is a stretch, given what we have seen with the stability in the marketplace and all. So I know I've just put only 3 ratings, So if it can't be good, maybe the best it can be is bad, but it's closer to being in the middle.
Between good and bad.
Good and bad. It's not anywhere close to us.
That's being politically correct.
This guy asked the question. Was this your response to your boss?
I'll get fired. How do you say that?
This guy. Anyway, why don't you guys tell us?
You wouldn't say that to my boss, Ranga.
Good, bad, or ugly?
Exactly.
So maybe I'll say, bad.
Let's put a poll out on our Twitter handle. Good, bad, or ugly.
Good, bad, or ugly.
What does the audience think?
Please tell us, let us know. Tell us the good also that you saw in the monetary policy statement, because we want to see more of it. Like I said, let's start looking at our reserves as import cover and not just as cash cover over the money supply in terms of ZIG. Let's see what happens in the next 3-4 months. We'll know whether or not we called it right, or
absolutely
we'll be pleasantly surprised.
Look, we at the end of the day, we try to be objective, and to the extent that we get things horribly wrong, we're happy to admit it. And actually, given our agreement that it's bad, we hope to be wrong.
That's actually true. Ladies and gentlemen, have yourself a wonderful Friday and have yourself a great weekend. Ours is just starting.
Cheers.
Cheers.